Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax preparer, planner, and translator of gobbledygook into clear action. Today we're unpacking the tax impact of how you fund life and business, loans, grants, equity, crowdfunding, and more. Big picture first. Money coming in isn't automatically income. Loans aren't income because you must repay them. Grants usually are income because you don't. Some funding starts non-taxable and later becomes taxable through forgiveness. We'll cover interest deductibility, the tracing rules, the business interest limit, PPP and other relief programs, scholarships, customer deposits, vendor rebates, asset purchases, basis and at-risk limits, and the documentation that keeps auditors happy. I'll share case studies and checklists to help you choose smart financing. Let's make it work harder for you starting right now, folks. Loans 101. When cash hits your account from a true loan, it's not taxable because there's an equal and opposite obligation to pay it back. The IRS wants evidence. Keep a signed loan agreement, amortization schedule, bank statements showing the deposit, and proof of payments. For informal loans from family, add a promissory note with stated interest and a repayment plan. Otherwise, the IRS may recharacterize the money as a gift or as income. Unexplained bank deposits are treated as taxable receipts. Label transfers in your accounting software. Memo lines like owner loan to business or operating LOC draw go a long way. If the lender issues Form 1099 INT for interest you paid, reconcile it to your books. And remember, loan proceeds are not revenue, but any interest you earn on loaned funds is taxable. Interest deductibility depends on use, not collateral. The tracing rules say, we follow the money. Borrow on a home-secured credit line and use it to buy equipment for your shop. That interest is business. Use the same line to pay personal living costs. That interest is non-deductible personal interest. Investment interest, like margin debt used to buy stocks, is deductible up to your net investment income, with excess carried forward. If a loan funds both business and personal spending, allocate based on how much went to each bucket and keep records. For home equity debt, post-2017, federal law limits home mortgage interest to funds used to buy, build, or substantially improve the home. Use a HELOC to renovate the kitchen, potentially deductible. Use it for tuition or credit cards, not deductible for federal purposes. Let's talk IRC Section 163J, the business interest expense limitation. Many small businesses are exempt under the small business test if average gross receipts over the prior 3 years are at or below the adjusted threshold, $29 million for 2025. If you're under that, the limit doesn't apply. If not exempt, deductible business interest is generally capped at business interest income plus 30% of adjusted taxable income. Real property trades or businesses can elect out in practice, but then must use slower ADS depreciation and forego bonus on property. Planning tip: watch your receipts aggregation rules for related entities, cash needs, and consider structuring debt at entities that qualify for the exemption. Time major depreciation deductions. Higher adjusted taxable income can support more deductible interest. And model state conformity: some states don't follow 163J. SBA and bank loans generally produce deductible interest when the proceeds are used for business. Fees are trickier. Origination fees, points, and lender charges tied to getting the loan are usually capitalized and amortized over the loan term under debt issuance cost rules. Annual service charges tied to balances are currently deductible. Read statements. Commitment fees for access to a line of credit are typically amortized over the commitment period. Unused line fees may be deductible as paid. If you refinance, any remaining unamortized costs from the old loan are generally deductible at payoff, while new costs start a fresh amortization clock. Keep the amortization schedule in your fixed asset or other asset register so the write-off doesn't get lost. And yes, SBA guarantee fees are not interest, so treat them like issuance costs. Forgivable loans and debt cancellation can flip non-taxable funds into income. When a lender releases you from repayment, the rule is cancellation of debt income, taxable in the year forgiven. Watch for Form 1099-C, Key exclusions exist. If you're in bankruptcy or insolvent to the extent liabilities exceed assets, you can exclude income and reduce tax attributes using Form 982. Real property businesses may exclude qualified real property business debt with basis reductions. Certain farm and student loan forgiveness has special rules. PPP forgiveness remains federally non-taxable and related expenses are deductible. However, a few states diverge on conformity or timing. EIDL advances, Restaurant Revitalization Fund, and shuttered venue operator grants are federally tax-free, but may be taxable at the state level. Planning move. Test for insolvency before year-end and manage timing of forgiveness. Grants and incentives are usually taxable for businesses because there's no repayment. Federal disaster assistance and certain COVID-era programs created exceptions. EIDL advances, RRF, and SVOG were excluded from federal income and did not reduce deductions, but states varied widely. Expect Form 1099-G reporting for many government payments and track by program so your preparer applies the right rules. Private business grants are taxable income when received or earned, depending on your method of accounting. Education-related aid has rules. Scholarships and grants are tax-free to the extent used for qualified tuition and fees, books, and supplies for degree candidates. Amounts used for room, board, travel, and equipment are taxable. Stipends for teaching or research are taxable wages. Keep 1098-T, award letters, and bursar statements so you can prove how funds were spent. Equity financing brings in cash without income, but it changes basis. In a C corporation, shareholder contributions increase paid-in capital, no immediate tax, but watch dividends versus return of capital. In an S corporation, a shareholder's stock basis increases with cash and property contributions, and with loans made directly by the shareholder to it. Third-party loans to the company don't increase your stock basis. Direct shareholder loans can raise at-risk amounts and free suspended losses. Partnerships add capital and share of liabilities to outside basis, affecting loss limits and taxation. Services for equity, that's ordinary income at fair value when vested, plus employment taxes. If equity is subject to vesting, an 83B election within 30 days of grant can lock in current value, shifting growth to capital gain. Miss it and tax can spike. Crowdfunding can be gift, sale, or investment. Gifts from many supporters with nothing provided in return are non-taxable to you, but platforms may issue a Form 1099-K based on gross payments. You report correctly and keep donor notes. Rewards-based campaigns are sales. Amounts are taxable income when earned under your accounting method, and sales tax may apply where you have nexus. Equity crowdfunding is an investment. Proceeds aren't income, but cap table and securities rules apply. Customer prepayments, deposits, and retainers are usually taxable when received for cash basis taxpayers. Accrual taxpayers may defer to when the goods or services are delivered, and one-year deferral methods exist. Vendor rebates can be income or a purchase price reduction. If tied to buying goods, treat them as reducing cost of goods sold rather than other income. Buying assets with financing. Your tax basis is the full purchase price, including sales tax, delivery, and setup, even if you paid a down payment. That basis drives depreciation. Section 179, expensing and bonus depreciation, can create large deductions immediately, subject to limits and income constraints. Financing doesn't reduce or increase the deduction. It's separate from depreciation. Plan cash and tax together. Sometimes you want slower MACRs to preserve deductions for future years. Startup and organizational costs follow special rules. You can deduct up to $5,000 each for startup and organizational expenses if total costs are below thresholds, with rest amortized over 15 years. Costs include market research, advertising before opening, legal work, and entity fees. How you paid doesn't change eligibility. Track these in separate accounts so elections and amortization are documented. Before we wrap, a few red flags: unexplained deposits, sloppy loan tracing, missing 1099 forms, and ignored cancellation of debt income invite audits. Another is taking business interest deductions on personal borrowing. Your defense is documentation. Keep loan agreements, notes, amortization schedules, statements, use of funds memos, interest 1098s and 1099 INTs, and any 1099Gs or 1099Ks tied to grants or platforms. Timing strategies matter. Align funding with deductible spending, bunch expenses into income years, and manage forgiveness or grant receipts to the most favorable year. Always check state and local conformity. A federal win can flip at state level. And bring in a pro when you face 163J, interest tracing, equity for services, or multi-state issues. That's today's tour. Financing isn't income until it is. Now you can spot the difference and plan ahead.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.